Ladies and gentlemen, I'm just going to be honest with you. Markets are going to crash further. The question is when? Does that start this week? Perhaps with NVIDIA earnings and last for maybe a couple of weeks, 10, 20% crash, pretty typical. Or do markets rally upon NVIDIA earnings? Do we have a year-end rally? And then we crash after inauguration. One of those things is going to happen. And I will tell you why that is throughout this video. It has to do a lot with tariffs, but don't be concerned. Because the actual reality of the situation is it's not going to be nearly as bad as Wall Street expects. In fact, Trump has been advocating for tariffs on China since the 1980s. And this already happened before, okay? Back in 2018, December more specifically, markets crashed exactly 20% upon a China-US trade war. You can see from about October 3rd until Christmas Eve, markets fell 20%. This was because of tariffs that were going to go back and forth between the US and China and the fear that this would just lead into a spiral known as the trade war. Well, the reality is it wasn't nearly as bad as markets expected, and both parties kind of U-turned on their rhetoric, okay? And we found a solution, and that was a trade deal in 2018. Now, a lot of those tariffs have stayed on ever since, and that's been fine by Wall Street. The problem is Trump has campaigned on a 60% just blanket tariff on everything being imported to the US from China. The reality is that's not going to happen. I'll tell you why in a moment. But the fact of the matter is, Wall Street believes it will happen. And that's the issue. Wall Street will be wrong. This will not happen. But they believe it will. Wall Street's not as smart as you think. Okay. Now, will there be some tariff put on China? Probably. But not as bad as we expect. The reason it will not be as bad as we expect is one, the bond vigilantes. Bond vigilantes are bond investors who sell or buy bonds to enact change. Okay, so it's one part bond vigilantes. This was a term coined by Ed Yardeni in the 1980s, when traders were said to have forced the U.S. Federal Reserve to take inflation more seriously by selling treasury bonds. A bond vigilante is a fixed income trader who sells bonds or threatens to do so to push back against specific policies of the issuer, the government. But it's also the stock market. See, when we start to get closer to these tariffs, tariff discussion, when you start to hear more about tariffs from the Trump administration, markets will sell off. Markets will crash, just like they did in 2018. We already know the playbook for this. And that will force change. That will force, less aggressive policy action. Because Trump doesn't want the markets to crash. Presumably, Trump does not want a recession. If the markets were to crash, that almost guarantees you a recession. If markets crash and there's no change to the policy stance. Okay, that's why tariffs shouldn't be feared in the reality of the situation, right? Long term, you shouldn't be scared of tariff rhetoric. In the short term, Wall Street is very scared of tariffs. Now, the question really is at this point, do the markets price in a potential China-US Trump trade war before the inauguration, like between now and year end, or do we price that in perhaps after inauguration when these policies could actually come to be? That is something I don't have an answer to. It's starting to feel like we could price that in before inauguration. It's starting to feel like Wall Street took all of the good that comes with a Trump presidency and priced that in as soon as he won the election. And now Wall Street's starting to say, well, crap, there's also some bad things that we must contend with. Now, I do think one of the deciding factors on whether markets crash between now and year end is likely going to be NVIDIA earnings. And I have to tell you, I'm not super excited about where things stand. And I'll tell you why. Just do a simple Google search, NVIDIA stock news. It's about as basic as it gets. And there's a lot of different opinions. From the Motley Fool, article out 8 hours ago says, prediction, NVIDIA stock is going to stall out on November 20th. 7 hours ago, from MarketWatch, will NVIDIA's earnings report signal a stock market pullback? Or you have other articles that say to buy NVIDIA stock before NVIDIA earnings. There's a lot of mixed expectations when it comes to NVIDIA. But the reality is NVIDIA's growth rate is slowing down. It's expected to slow down. Even though I expect NVIDIA will have great numbers, they will beat on the top and bottom line, the bar is being raised for NVIDIA. Just look at this article from Barron's. NVIDIA stock gets a price target hike. The stock is down anyways. You had like 4 price target upgrades on Friday alone, or really last week, with the highest one being $200, the lowest one being $160, right? Expectations are being ramped up into NVIDIA's earnings. That's a problem. Now, NVIDIA has a history of selling off even on good earnings. And given where the stock is at right now, it's sitting at $142.70. You have not fallen much heading into NVIDIA earnings. On Friday, NVIDIA was down about 3.26%, up 0.5% in after hours. You're still trading near an all-time high. Okay. I don't think that's a favorable setup on a risk to reward basis. Now, in this article from MarketWatch, it says, will NVIDIA earnings report signal a stock market pullback? It says here a stock market warning and one for NVIDIA. Tom DeMark, a veteran market analyst, believes that the U.S. stock market is nearing a top with a technical analysis showing parallels to conditions preceding the market crash in 1929. In an email to MarketWatch, he also said that NVIDIA was nearing a point where another record high for the stock could trigger a sell-off. He says it's currently at countdown 12, and a new closing high would complete its rally. He says the upside potential is $154.50, while the downside risk could be significant. He also says, quote, the past 2 weeks rally has been on stilts, and a sudden suspension of buying, even without selling pressure, could undercut the rally and transform into a seller's market. Granted, good news could unlikely extend into inauguration, but at any time, once buying interest is interrupted, subsequent rallies should be short-lived. Now, in this article from the Motley Fool, it says NVIDIA stock is going to stall out on November 20th. It says the perfect storm may be brewing for NVIDIA. They go on to say that NVIDIA is really, their chips are overpriced, right? Their selling point is between $30,000 and $40,000 per chip, where other competing AI GPUs are priced between $10,000 and $15,000. That NVIDIA is supply constrained, so other competition or other customers may just go to their competition, like AMD, which has gained some market share, though small, some market share from NVIDIA. And their chips sell at lower pricing points. So instead of basically waiting months to get your hands on NVIDIA chips, you may take AMD chips because they're available now, for an example. Okay, which definitely can start to impact pricing at some point for NVIDIA. And this did not happen in the last quarter. We can say that with pretty much certainty. But Wall Street doesn't care about really what happened last quarter. The only thing that matters with NVIDIA, what's going to happen next quarter, and the quarter after that, and the quarter after that, right? So if the expectation becomes maybe pricing gets weaker, that's a problem. Now, this article says a bigger threat to NVIDIA might just be internal competition. Microsoft, Meta, Amazon, and Alphabet are internally developing AI chips for their own use cases. Yes, I think that's a longer-term problem for NVIDIA. That he says here, or Motley Fool says here, NVIDIA is still constrained by chip supply. Of course, that is true. The export controls from NVIDIA to China, the number 2 second largest economy in the world, is probably going to get more stringent under a Trump presidency. That we can also agree with. They also say that insider trading activity provides the fifth puzzle piece of the perfect storm for November 20th. Over the past 47 months, no executive or director has purchased a single share of NVIDIA stock on the open market. While there are plenty of reasons to sell a stock, not all of which are nefarious, the only reason to buy shares of a company is if you think they're headed higher. The actions of NVIDIA executives and directors make it clear that NVIDIA stock isn't viewed as a good value. The sixth and final reason I'll be looking for NVIDIA stock to hit a brick wall on November 20th is history. Over the past 3 decades, investors have consistently overestimated how quickly a new technology or innovation will gain utility and or adoption. This leads to lofty growth expectations that eventually, keyword, come up short. Despite ample demand for Hopper and Blackwell, what's sorely lacking from NVIDIA's customers are well-defined plans to monetize their AI investments. In other words, businesses are buying, but there's no clear use cases. All technologies need time to mature, and artificial intelligence is unlikely to be the exception to the unwritten rule. In my view, this puts NVIDIA stock in a precarious position come November 20th. And although I agree with every point that is listed here, I don't agree with the timing necessarily, right? Eventually, all of what he's saying will be true. Eventually. Is that this quarter? Is that next quarter? Is that a year or two from now? The timing is an issue here. And I don't think Wall Street's going to jump to the conclusion of, AI adoption is going to take longer based on this quarter. I don't think we're going to get indications from that from NVIDIA. NVIDIA is probably going to come out, be top, bottom line. They're going to say things are great. Question is really about pricing, in my opinion, for this quarter, and what the guidance is for pricing over coming quarters. Really what the guidance is from NVIDIA. Maybe NVIDIA is going to sell more chips, but maybe the pricing is going to be a little bit lower, right? The guidance will be important there. And I just think from a purely just risk reward position, you're just not set up in a favorable way. And that's the easiest thing we could say about NVIDIA's earnings for November 20th. And the reason NVIDIA is probably going to sell down following earnings, which again, let's face it, NVIDIA is the markets, because NVIDIA really trades alongside other big tech stocks, which accounts for about 40% of the S&P and the NASDAQ. So if NVIDIA sells off, the markets are going to sell off. That doesn't necessarily mean that all stocks need to sell off. NVIDIA selling off, big tech selling off, does not mean that we are guaranteed going to see small caps sell off, or the Dow sell off, or cyclicals, or value, or dividends, right? Theoretically, you could see big tech sell off and the rest of the markets rally. But then you get into the whole tariff discussion and prospects for a US-China trade war, and that kind of makes me less excited about a potential broader market rally. Now, it's possible that animal spirits continue to run high into year-end, and then we sell the inauguration. But it's starting to at least feel like Wall Street is starting to pay more attention to what a trade war between the US and China could look like. And markets do price things in ahead of time. So if we expect tariffs could be enacted pretty shortly after Trump takes office, then we may price that in ahead of time, which would likely be from now until year end. Now, I listed out the bearish and the bullish, potential catalysts for markets here. On the bearish side, we have high valuations because of high expectations of growth. But really, the S&P and the NASDAQ are expensive on an index basis. But the average stock in those indexes are trading at average valuations, historically speaking. They're not that expensive. So you could see a broadening out of our markets, and it wouldn't be super surprising. At the same time, big tech could sell off, and that would honestly make sense given just how overvalued those names are. Now, less Fed cuts, that's obviously a problem, but it's due to the economy being a little bit better, so I don't see it as a huge problem. Uncertainty about tariffs and how China will respond. This is number one, first and foremost, the biggest issue we will have at some point over the next 3-4 months. This will cause a 20% crash at some point, unless Trump just totally U-turns and says, we're not going to pursue tariffs against China. That seems unlikely to me. It's possible, but eventually this will cause a 20% crash in markets. And then obviously Trump will then take the stance of, we're going to do small tariffs, and markets will love that. That's just the game plan. That's what's going to happen. Whether you like it or not, I mean, take the information and do what you will with it. I say here, NVIDIA earnings nearly priced to perfection. Analysts are raising the bar, and analysts are really setting NVIDIA up for failure. Because they're raising the bar, it's going to be a lot harder to impress. Now, I write here, the economy has room for downside surprises, already running at about 3% GDP, which could come in the form of lower government spending, which could be negative for the economy. Meaning that if you're already running at 3% GDP, I think the risk is that you undershoot that, right? That growth slows down, not that you accelerate to 4%, but perhaps you fall to 2%. Now, government spending, we're spending as if we're already in a recession. So that's been very stimulative to the economy and to the markets. If some of that starts to slow down, that's a problem. Now, on the bullish side, you have bond vigilantes that won't allow Trump to enact bad tariff policies. Okay, so it's really bond vigilantes as well as markets. If the market goes down 20% and we're knocking on the doorstep of a recession, you're not going to get these bad Trump tariff policies. Okay, that will be bullish. It will be bullish for the longer term of our markets. But in the near term, again, you will see some pain at some point. The markets, again, excluding Mag 7, actually trade at historically average valuations. We talked about that. There's $7 trillion of cash on the sidelines. I don't know how to paint that in a negative light. Rolling recession could come to an end. It's clear we've been in a rolling recession with different sectors going through this for years. It's not super, crazy for one to believe that maybe the rolling recession comes to an end and things get back to a more normal, consistent kind of trend of growth. Lower corporate tax rate. That's obviously going to be good for markets. That's going to be good for the economy, hopefully. Lower government spending / lower inflation. Now, lower government spending can hurt economic activity, but lower inflation could allow the Fed to cut rates more than expected, and that would be positive for the markets, right? Lower inflation would be good for the markets because inflation is only government spending. People, as Milton Friedman once said, people have always spent all their money, consumers that is. Companies have always been greedy. They've always tried to have the best margins possible. The only variable is government spending. And that's why we have inflation. We're spending like we're drunken sailors, right? That just found a treasure chest of gold and we're throwing it off the ship. Like it doesn't even matter. That's how the government's spending money right now. That's factual. No need to debate that. So lower government spending perhaps means lower inflation. Now, I can also add to this deregulation, which makes things get done faster, which can really boost economic activity. If it takes you 12 months to get permits to build a house in California, if perhaps that now takes six months, then obviously that's going to create more homes, create more business, and that's going to be good for the economy. And it also helps to kind of support some of the more loftier valuations in markets. Now, these are all more longer term things, right? Second half of 2025, bullish catalyst. I think between now and, spring of 2025, you will get a 20% crash at some point because of the expected tariff policies. Even though I can confidently sit here and tell you after the crash, after the bond market freaks out, you're not going to get drastic tariffs, right? We're not going to see those. Wall Street is still going to expect them. right? At least until we get proven otherwise. And just Wall Street expecting that is going to cause markets to crash. So longer term, second half of 2025, I'm very optimistic about, lower corporate tax rates, deregulation, not as, crazy extreme tariff policies as was promised on the campaign trail. Like, these are all very positives. In the near term, valuations are high for big tech, which they basically control the broader index. Nvidia's bar is getting raised into earnings, which sets it up for a disappointment. How big is that disappointment? I don't know. Is it just small, or is there an actual problem with pricing or margins that is given to us in the form of guidance? In other words, is guidance bad? I have no idea. We will see on Wednesday. I think Monday and Tuesday will be important as well. Do people sell Nvidia into Nvidia earnings, or do they buy it into earnings? That'll kind of tell you a little bit about expectations in and of itself. And it does seem like the markets are getting a little bit more concerned about the Trump tariff policies right now. At least that's what it seems like happened a little bit of last week. You've almost given back the entire Trump rally so far. And this, I do think, is a near-term problem for markets. And it will give you a crash at some point. Now, what I'm personally doing is I want to stay invested in this market. I'm not selling any stocks. Maybe some winners, it makes sense to take profits on maybe Nvidia if you have it, or maybe some other big tech stocks, just because I think they're so overinflated. I've already done that, so I'm not selling any of my small caps or mid caps or average stocks. I'm not selling a PayPal here. I'm not selling a Dollar General here. I'm not selling, AbbVie here, right? Some of the other stocks that I own. But I am trying to raise as much cash as possible. In real life, right? Whether that's taking side jobs or doing this or doing that, I think that's probably a good practice for everyone. And getting ready, because I don't think that there's insanely high chances of a recession. I think there is clearly a chance of a recession, especially if the markets crash and nothing changes, which I think is unlikely from a tariff policy stance. So I do think the crash is something you want to buy. You always want to buy crashes or corrections, but I think you would really want to buy this one. When it comes, who knows when it comes, but you want to be ready for it when it does come. Okay, you want to be in a position to take advantage of it. And that means getting cash ready on the sidelines. I also think hedges right now make a lot of sense, as the VIX is still trading at pretty low levels, especially if markets rally Monday and Tuesday, which is not super far-fetched in my personal opinion. Then that would be a good opportunity, I think, to put on a hedge or two. You don't want to go too crazy, because it could take some time before the 20% crash comes. But I think just with Nvidia earnings, there is a risk for markets throughout this upcoming week. Hedges, though, you always want to go into it with the assumption that you're going to lose all your money, because it's a hedge, and hopefully you have a large portfolio that'll make up the gains of the hedge that you lose on, right? Contact a financial advisor before making any decisions. I am not a financial advisor. Your situation is different from mine, and yours is different from the next guy. But I do see a hedge or two as a favorable kind of way to position a portfolio right now. But ultimately, I think you want to raise some cash. You want to get your shopping list ready to go shopping when this crash does ultimately come. Let's call it 20% from all-time highs, which was about 600 on the SPY. That's going to put markets down to about 478 or so on the SPY. A 15% crash, which some would say is a little bit more in likely territory, is going to put the SPY back to about 510. There's going to be a lot of good deals at that time, I think, when that does happen. Question is, does that happen between now and year end, or does that happen after the inauguration in late January, in February or so, maybe March? Let me know your thoughts and your expectations down below in the comment section. Ladies and gentlemen, you guys have a great rest of your day, and I will see you in the next one.